Welcome everyone to our latest InterMET.digital webinar. Today's topic is focused on the challenges and opportunities facing people who have left the public and academic sectors to set up a weather business. I'm Jan Dutton, and I'm the CEO of Prescient Weather, the creators of the World Climate Service and Crop Profit. Today we welcome 4 expert panelists. They are Dr. Carlos Gaitan, the CTO and co-founder of Benchmark Labs, Dr. Josh Hacker, co-founder of Jupiter Intelligence, Rebecca Leonardi, managing partner of Weather Risk Global, and Alan Richards, partner and co-founder of West Hill Capital. Each panelist will give a very brief overview of their work, and after that, we'll move on to a panel discussion and audience Q&A. We've had some questions in advance, but we're hoping that you out there in the audience are thirsty for knowledge, and we look forward to receiving your questions via the Zoom question and answer capability. We'll be looking at these questions once our experts have finished their presentation. One final word, please bear with us if there are any technical glitches. So before handing over to our panelists, I just want to make a small contribution myself to make sure that I get to contribute to part of the fun. So the topic, as I mentioned, is the challenges and opportunities that are facing people leaving the public and academic sectors to start a weather business. And I have my own brief experience that I'd like to share. So right out of graduate school, I started a business, and I actually had a marketing professor give me a piece of advice, which was to take a bit of the startup money that I had to start this company and to go visit customers and find out what they wanted. And like, what did I know? So I completely ignored them, and we started building products right away. And I can say 22 years later, I wish I had listened to his advice. And so one of the things I say today, or I've said it many, many times in meetings talking about products and what we're trying to do, is that it's really easy to sit around the table and come up with product ideas on our own. But it's really difficult to talk to customers and figure out what they want and figure out how to build what they want. But it's really a critical component of succeeding. So one of my lessons learned very early on was make sure you're talking to customers or potential customers. So without further ado, let me introduce our first panelist, Dr. Carlos Gaitan, who is the CEO and CTO and co-founder of Benchmark Labs. Carlos's current work revolves around providing asset-specific environmental forecasts for the agricultural sector and beyond. Most recent solutions include drought forecasting conditions in collaboration with NASA and analyzing the impact of COVID-19 on forest fires. Carlos, take it away.
Thank you, Jan. Thank you for the great introduction. So it's my pleasure to be in this panel. I want to just do a brief introduction about my work. Jan, could you please let me share the screen? Excellent. In the meantime, I will continue like what we do at Benchmark. So Benchmark, as Jan was saying, we provide asset-specific forecasts. Why it's important? It's because it comes from the customer's need. As Jan was mentioning, it's actually key to first talk to customers, find what they need, what they called an investment, the product market fit, and then you build a product. There are many cases, innumerable cases in startups where you build a product that nobody wants to buy or that actually doesn't provide any, or provides a marginal improvement on what they already have. It's too complicated to integrate into the customer systems. What we did in Benchmark Labs is we saw a gap in an underserved community, basically, that was needing high resolution information and they were not getting it. And that's how we decided to build our solutions. Specifically in Benchmark Labs, we want to integrate with what the other panelists are going to mention later on. We saw that basically in agriculture, energy, and insurance, all these great sectors having like billions of dollars in total addressable market, some of them, or most of them, have a same need. It's called the spatial basis risk or basis risk. That comes basically because there is an uncertainty on the information that the insurance companies or agricultural companies at the farm level or energy companies have between the observation that they have available from weather models or from other sources of information, and the information that actually, or the data, the variables that are recorded at the fields that they need, at the asset that they manage, or at the insured party. So that discrepancy in information, sometimes they don't have it, sometimes it's imperfect, sometimes it's an average over a bigger region. That causes inefficiencies in markets. For example, those inefficiencies get translated into higher pricing for insurance companies. You cannot trigger your parametric models, for example. In energy, you cannot quantify exactly your energy generation. And in agriculture, you might be selecting average conditions that could or could not, for example, take into consideration special effects like sea breezes, lake effects, orographic precipitation, and so on. So that's how we ended up like trying to help the people that really need specific information at the point level. I see here we have a chat. Okay, no, it's fine. So just to continue this, probably without the slides, so we can go to the next speaker soon. But we did a benchmark. It's after talking to customers, we had in the previous companies and in the academic sector, I was working for the Climate Science Center Adaptation Center from the USGS too, and in collaboration with NOAA, the Geophysical Fluid Dynamics Laboratory. It was a nice component that drove me to go outside the ivory tower and talk to customers, in this case, stakeholders, say, what do you need? From the perspective of somebody that used to work at government, they said, but you have everything, you know, the data is freely available in the United States. It's in a beautiful format called NetCDF or GRIF. It has metadata. But when you talk to the actual users, they said, I cannot open those files in Excel. I don't know what they do. You could have like terabytes of information, but for me, they are not actionable. I cannot know. I don't know how to use them. I don't know how to extract information, and so on. Then you start to see inefficiencies in the way that academics treat information that is publicly available. Imagine IPCC report data for climate change assessments. Imagine weather data for day-to-day operations in the National Weather Service. And what the actual users know, that sometimes they don't have the spatial background in Python or machine learning to do operations and read these formats. So I think that that's important to understand them, where they're coming from, and help them if needed. And there are many opportunities where companies can build services, just refining what is publicly available, also repurposing it, making them more accessible, creating visualization dashboards, and in other cases, bringing value added. So, Jan, do you want me to? Yeah, okay, perfect. The screen is shared. Excellent. So going back to what we're saying, the company purpose, as Jan was introducing it, basically we provide IoT forecasting solutions where we linked environmental sensors and weather data. And that's how we create asset-specific forecasts for specific locations. So as mentioning, only talking about the weather forecasting, it's a tiny market of $4 billion, sometimes big enough for VCs that look at least at 1 billion addressable market opportunity. But this is only the tip of the iceberg. If you look at insurance, reinsurance, assets, analytics, data management, those are markets that are like 10 times, 20 times bigger than this weather forecasting that is very specific. So I was mentioning before, opportunities come in our case, for the spatial basis risk, on how you refine them, how you provide information for people that really need high resolution data at the temporal and spatial space. Solar panels get affected by cloud cover, that is local. Wind turbines get affected by orographic effects that happen at a specific mountain, not average over conditions over counties. Farms are in a specific terroir, not in a county, or at least small farms. Most of the world has small and medium farm sized operations, and commercial residential real estate needs to be managed at the asset level. So about the challenges, and that's how I want to integrate this with what we are going to talk in the panel. The opportunities were there, and as I was mentioning earlier, but what about the challenges? And this is something that we had to face as companies, startup and medium-sized companies. The questions that you answer when you are raising money is like, okay, how you compete, who are your competitors? And in many cases, the competitors offer free data, publicly available data, whether apps that provide data for free, governments that provide data for free. Then second question is like, there are big players there. We already have AccuWeathers of the world, IBMs that bought the weather company, and companies that have been doing this and have like budgets that startup cannot compete with. Even the European Center of Medium Range Weather Forecast, the ECMWF, is probably state of the art. It's a wonderful operation, provides API access to the data. So how you compete with them? And then the perception. And this is something that I had heard even raising money like in previous years. Like some of them say like, okay, just do it, but who cares about the weather? Who cares about climate? What if you are like more accurate? But who cares? Is that 10%, 50%? Who cares? So all of those things probably we'll talk in this panel, and I just wanted to leave it there. Thank you for your time. Your benchmark labs. Jan, back to you.
Great, thank you, Carlos. I'm sure we'll be returning to some of the points you've raised, but now let me introduce you to our next panelist, Dr. Josh Hacker. Josh is a co-founder of Jupiter Intelligence and leads the company's science team. Jupiter is a venture-backed startup formed to address the rapidly growing need to bring cutting-edge climate science to the economy. The primary focus is on physical risk, which arises primarily from extreme events, and how this is changing as a result of climate change. Josh, it's up to you.
Thanks, Jan, and excuse me, good morning or good afternoon, depending on where you are. Thanks for having me today. Yeah, most of my career was spent in at the National Center for Atmospheric Research, or NCAR, that I'm sure many of you are familiar with. I also spent some time on faculty at the Naval Postgraduate School, returning to NCAR to begin learning and executing on science management before jumping into the private sector in 2017. And we really started Jupiter because we saw a market that was already cracks a crack there, but really was beginning to open up. And we believed it was going to open up very quickly over the next several years. And that's kind of where we are now. So I would characterize the market right now as a Wild West. It hasn't really sorted out. It's a lot far less mature than the market for weather information. And so a lot of what we're doing is figuring out how to bridge that gap, that valley of death, that last mile, that distance between real climate science and modeling and what the stakeholders in the economy actually need. So let me just give you some idea of what we do. We have two product suites. At the end of the day, really what we're doing is downscaling climate information, and to overuse a term, it's creating climate, it's taking climate information from projections and even historical trends and making it actionable. Like I said, various economic sectors are still figuring out how to use this information. They widely know that something needs to be done, and there's information out there, but everything from the interpretation to the technical aspects of consuming that information is still being defined in the market as we speak. So our approaches to downscaling really range from dynamical statistical hybrid approaches to empirical approaches, which can include conventional statistics or machine learning, for example. So I already mentioned a bit about the market already. It's very quickly opening right now. That also means it's very quickly evolving. As I'm sure many of you are aware, climate science has a long tradition in the public domain. The vast majority of climate science happens in universities and labs. And of course, the GCMs that are responsible for the projections are pretty much exclusively in labs and universities at the moment. It's my belief that will remain true for the foreseeable future. There's not a great push to pull climate science out of universities anytime soon. So I think there's some analogy here between what we saw maybe beginning in the 80s or even earlier in some cases, but sort of the rapidly expanding weather sector and weather enterprise in the private sector that we saw kind of in the late 80s and going through the 90s and to becoming very, very mature today. We're sort of back, we're three decades later, but in climate science, I think we'll see a maturity of this over the next several years. That's going to happen very quickly. We're just not entirely sure what that's going to look like yet. So what we do see so far is, people often ask us, so who are your competitors? Well, I would say, with my tongue partially in my cheek, that we have no competitors. One of our differentiators is that we built the team science first, where most of the people who are playing in global climate science analytics are really focused or have been focused on the financial impacts and less on the physical component itself. And so we've spent our time, the vast majority of our time, building out the ways to take, again, those climate projections into something that can be used for a broad range of applications in the economy, not just the financial sector, for example, although that is one of our key areas of focus. So what do I do in my day-to-day job? A lot of strategy. The market's moving quickly. We need to be nimble, which is one advantage of a startup. We can move quickly to adapt to the market. But this includes everything from how we're sort of high-level views on what products we're going to build, what science we're going to include, to making sure that we're hiring people that meet those demands and can be as agile as the company that we're building. Once we have the team, about half the company right now is the science team. A lot of what I focus on is making sure that my team is aligned with the company priorities, where the company priorities are really defined by this evolving market. So it's kind of a moving target, if you will, at this point. A lot of what I do is also make sure that the quality of our product and the science behind it is accurate, or is high, I should say, and that we are prepared to explain our methods, our approaches, assumptions, both in the climate model projections and also in our own downscaling methods, how we approach the open source community, and a bunch of other sort of related activities around that. And then I also spend a lot of time personally engaging in customers and in business development, because one of the key things we need to worry about in all business, but it's most acute in a startup, and you just heard about this from Carlos, is aligning the development with what's actually going on in the business world and how those needs are being defined. And that's kind of the key challenge, and making sure that we remain focused on that. I think that's all I have for today. I look forward to the questions a little bit later.
Great. Well, thank you, Josh. That was very interesting. And we are now going to introduce you to our third panelist, Rebecca Leonardi. Rebecca is one of the original founders and partners of Weather Risk Global, an international weather risk solutions company that provides risk transfer products and services to individuals, organizations, cities, and nations worldwide, and is a key player when it comes to mitigating financial risk in the renewable energy space. The insurance sector is one of the major users of weather and climate information, and Rebecca will help explain a little bit more about the potential use of weather and climate information within the insurance and weather risk industry. Rebecca?
Thanks, Jan. I appreciate it. It's great to be here. So Weather Risk Global was started about 11 years ago now by myself and a couple colleagues. It's really a weather risk solutions and brokerage firm. And we specialize in assisting clients to navigate and financially mitigate the effects of weather anomalies. And a lot of these anomalies, more than anything, are financial. So for anyone who's not familiar with weather derivatives, which are unfortunately for us, a lot of the people that we run into, weather derivatives are financial contracts that companies, governments, or even nations use to mitigate risk due to adverse weather. So they're based on predefined weather triggers, which could be rainfall, snowfall, even humidity, wind. And these products pay out when the weather meets or exceeds these predefined indexes. So the payouts can be applied to any financial loss, so lost revenue or increased expenses, and there's no claim filing process, which is really what sets us apart from traditional indemnity-based insurance. So in the event of most traditional indemnity-based insurances, the event occurs, the insured assesses the damage, then they file the claim, then the insurer reviews the claim, the adjuster validates and assesses this, and then the claim is paid out. Oftentimes this takes 6 months to a year to happen. The big benefit of a weather derivative is that this is a lot quicker. So with the process of weather derivatives, the weather trigger is met. Let's say it's wind, category 4 hurricane, for example. The observation is verified by a third-party data provider, and then the payout is issued within 30 days. Sometimes we see this as, even a week or 2 weeks, we see people getting payouts. So this is a huge benefit, especially in cases of catastrophic damage, when most of those people can't wait a year, 6 months, a year, 18 months for that money to come back to them to rebuild. So here are some of our solutions. We create these solutions for clients to use based on all kinds of different industries. They're designed to financially compensate for everything from minor changes in rainfall or temperature, which would be somebody like a farmer that would run into that problem, up to catastrophic damages of like a Cat 5 hurricane. So the catastrophic protection provides immediate relief and recovery funding after the event occurs. With regards to farmers, somebody that has a small farm could lose their entire crop. Let's just say even if the temperature dips down into a frost. That's an example of something that we would consider we can cover with full season coverage. We don't call that a catastrophe, but for the farmer, it could definitely be a catastrophe. And then within those two extremes, we cover everything in between, ski resorts, oil and gas, all kinds of other industries, retail, that can use these solutions. Some of the newer solutions we're using are the green energy. We use these to reduce price risk in the solar and wind industries, and that allows the clients to optimize their stock of their assets. And all of this is just done on really a platform that identifies and mitigates the risk associated with these losses. And in other words, we're aligning the financial data with the weather data to identify the business risk, and then we create the products based on that risk. So this is a quick example of what the coverage process looks like. We identify how specific the weather conditions affect our business and revenue, and then we design the coverage based on the location's past weather observations. This allows us to come up with a hedging program that's more suited for the financial risk of the client. The parametric weather coverage contract is secured with coverage with a coverage supplier. So most of these are major reinsurance companies, and they are paid a one-time premium. Then the specific third-party weather data provider observes and records the daily weather conditions during the coverage period. And then lastly, a payout is is then made after the final settlement is calculated. So thank you.
Thank you, Rebecca. What I really like about your business and your representation on the panel is that you're very much a user of the same information in terms of weather data and climate data, but it's a completely different service model, different risk set, and it's an innovative use of the information to try to solve customer problems. Our next expert and final expert is Alan Richards. Alan is a seasoned corporate finance professional with a strong track record in science-based startups. West Hill Capital has to date invested in one directly related weather technology business, Windar Photonics, which uses LiDAR sensors to increase the efficiency of wind turbines. In addition, they have backed a number of groundbreaking new technologies, including UniBio, a fermentation technology which decouples protein production from farming and fishing, CPH2, a green hydrogen production with a membrane-free electrolyzer, and Particle 3D, 3D printed patient-fitted bone implants. Alan, let's talk about investing in science.
Thank you, Jan. Good afternoon, everybody, and thanks for tuning in. Let me start with a few words about West Hill Capital, which has raised £240 million for 36 early stage companies in 100 rounds since 2014, including 60 million in 2020. We've been busy throughout the pandemic. We focus on technology companies. We source deals from partners networks, including university spin-outs, corporate incubators, and from known entrepreneurs. And we invest at seed and all the growth stages. We syndicate each investment with a captive network of about 1,000 high net worth investors. And most investments qualify for the UK's Enterprise Investment Scheme, which gives various tax reliefs to investors. We've achieved 5 exits to date, the most recent one being a $400 million sale of Humio, which is a log data management company, and that was sold to the NASDAQ listed CrowdStrike just last month. Raising capital is hard work, and venture capital investors are very selective. Successful entrepreneurs can spend half their time raising capital. As soon as the ink is dry on one round, they're preparing the pitch documents for the next round. So how do you prepare yourself for this marathon? What are investors looking for? And will they even invest in a weather business? Fortunately, the business of weather is large. It's a large market and it's growing. So that's 2 boxes ticked for investors. A financial database company called PitchBook tracks 1,800 companies in the climate technology vertical, which includes energy, agriculture, and transportation. And they estimate the market to be worth around $2.5 billion in 2020, growing at a rate of 9.5%. Researchermarkets.com estimates a market for weather forecasting systems of over $5 billion by 2024. And that's also growing at an annual rate of about 9%. Venture capital firms have been investing in weather businesses, taking the 6-year period, 2016 to 2021. PitchBook has tracked a total investment of $540 million in weather forecasting and weather information businesses. And that's in 90 companies and about 300 investors. There have been 190 deals in that same period, with a median deal size of about $1.4 million, averaged over all the investment stages: seed, early stage, and later stage. So VCs are backing innovative weather businesses, but what are they looking for in a prospective investment? Well, they're looking for businesses that scale rapidly, preferably globally. And that usually means products, software, platforms, and not professional services. They want a deep moat to protect from competition. So that means patents, computer code, technical know-how. They like companies with recurring revenues. So that's subscription models, software as a service. And they like a clear route to exit. And they will probably have identified that even before writing out the investment check. And the VC firm's investors will expect to make a return, obviously. And they're looking to make 3 to 4 times their committed capital over the life of the fund. So to achieve that, and recognizing that some companies fail completely and return 0, the VC firm will be targeting returns from individual portfolio companies of around 10 times over 5 years. So that's an annual growth rate of 60%. Now, the best VCs bring more to the table than just capital. If they invest in your company, you'll be joining a portfolio of other investee companies that you might be able to learn from or even trade with. You'll be given help to hire the best talent. You'll be advised by seasoned industry veterans. You'll be given assistance to join new geographic markets and increase sales and marketing. And finally, you'll be on the radar of other investors who might co-invest in your next round, or strategic acquirers looking to buy your business, and Wall Street bankers looking for the next hot IPO. Here's a few of the investments made by venture capital firms in weather businesses over the last year, year and a half, in the USA, in Europe, and in Asia. So the largest one over that period has been Spire, which very recently announced a potential New York listing with a special purpose acquisition company called Navsite Holdings. And that's valuing Spire at around $1.5 billion. Climacell just yesterday has been rebranded Tomorrow.io and has raised $77 million from Stonecourt Capital. In Finland, Skyfora raised $700,000 from Voima Ventures. We've got a couple here from China. Jufang raised $3.3 million from Zhengzhuan Investment. And Qingqing Data raised $200,000 from Tongfang Company. And finally, Josh's company, Jupiter, last summer, they raised $10 million from a number of investors led by Liberty Mutual Strategic Ventures. Thanks for listening. Good luck with your new business. And I'm handing back to Jan.
Great. Well, thank you very much, Alan, and for all of the panelists for their great insights. Once again, I'll just tell the group attending that if you have questions, please use our live Q&A facility, which is located at the bottom of your Zoom screen. And so we are going to go ahead and start with some of the questions. There's already a few questions in the question and answer session. We've had a few questions lined up already, and we'll go ahead and get started. I'm going to start by bringing 2 seemingly unrelated questions together. So there is a question about, let's see, that the priority of the meteorology sector in terms of the global weather enterprise is to enhance the capacity of national meteorological services on cost recovery. And the person mentions that aviation is currently a significant source of income for lots of the national meteorological services. And the question is, what support or solutions can national meteorological services explore? And I'm going to link that actually with, there is a question That is, what does the insurance industry use? So I'm gonna edit this a little bit. What data does the insurance industry use, and where does it come from? And what opportunities are there for innovative startups when it comes to value-adding data? So the reason I'm linking those two is my view of like the primary source of data in much of the weather industry is that the original sources of data comes from national meteorological services, generally scattered around the world, and that value adding is occurring. So Alan mentioned a few startups that are launching their own constellations of satellites, or they're creating their own observation systems. But much of the sort of fundamental science comes from the national meteorological services. And so I guess let's open it up for discussion if someone wants to raise a hand or just answer. But when we're providing services of one kind or another, what is the source, the original source of the data? And then I'll ask a follow-on question, which is, are there opportunities for national meteorological services to participate in what we call the private sector? Anyone? Come on.
Yeah, I will take it. I will take it if you want. Josh, you want it? That's a tricky one, because I could consider that I will be directly benefiting my direct competitors as a national weather service. But, but to your point, in many ways, in the United States, we are blessed with the Freedom of Information Act, where the data can be, if it's basically financed by taxpayers' money, can be made available and should be made available. But that's in the United States. Other countries have different monetization strategies. Originally, I'm from Colombia. The weather service there monetizes for the access of weather station data. They charge for years that you need to get for hydrological studies or so on. And they also have a kind of a consulting realm where if you need higher data, higher resolution data, you can get a premium. You will get it, but you will have to pay for it. Or there are agreements where you have to pay for costing. The alternative too is to use a hybrid model like the ECMWF in Europe, that some of you are familiar with, where the data is free or some data, it's free, publicly available for research purposes and for members of the European Union, but they charge sometimes significant amount of money if you are a startup, like 120 euros, 1,000 euros per year. I think that was the access for their forecasting suite, and that's a way that you can monetize it as a weather service. So the ECMWF is actually doing it. They have a system where they provide data for free for their stakeholders, direct stakeholders that fund them, but if you're outside of the union, you have to pay. So those are like two different options that you can monetize it. And to the point of the aviation, that's for sure, it's a big one. Aviation, even military branches pay for research and development of government, which doesn't necessarily reflect on operational money that will go to you, but they fund the research and development of thousands of projects worldwide every year, improving funding for radar, for observations, radio zones, and so on. So, and directly, there are ways that the governments can get funds, maybe not as a startup or as a weather analytics company will get, but they get pots of money from different agencies too. So that's, from my perspective, how an agency could monetize.
Great. Josh, did you want to add to that?
No, I think Carlos pretty much got it. Maybe I'll just comment that, yeah, I mean, it's always a tricky balance between what the public agencies are trying to do and where the private sector is trying to go. And my own belief is that there's plenty of room for everybody as long as the quote unquote swim lanes are well defined, which is not always the case and hasn't always been the case, even in the weather industry. But I think by now, in most parts of the world, they're fairly well defined.
There is a well, there's a second element to one of the questions, which is what opportunities are there for innovative startups when it comes to value adding data? And I'll provide my input, which is my view is there's an absolute tremendous amount of data in the world. It's incredible. There's more data than we're ever going to be able to analyze probably. And at the same time, there's a long list of business risks and business requirements that could benefit from value-added weather data. So I don't have a specific answer to what opportunities are there, but I would say the opportunities are the fact that business needs are emerging because of changing weather and climate conditions, and new solutions are emerging because of the availability of data sets that were previously not available. And the opportunity is to find the middle ground in there, to find the data and create solutions based off of it.
So Jan, based on our business, I definitely believe that some of the opportunities lie in more of the exotic structures. So for us, things like lightning cover, some new flood mapping cover, those are things that we don't have yet. But if we look back 10 years, we didn't have wildfire cover 5 years ago, and we didn't even have real hurricane cover 10 years ago. So yeah. I think we are sort of moving towards what people are looking for every day.
That's a great example. Do you know within the specific weather risk industry, do you know, have there been contracts written recently that are only possible because, let's say, we've reached a time where the data set is long enough that the risk could be understood? Like, is there a new sort of innovative contract written recently?
Sure. And lightning actually is an example of that. So we didn't have 15 to 20 years of historical lightning data until recently. So now that we do have that data, we can write cover on it. And there are certainly a couple companies doing that. So that's a great example of.
Great. Alan, may I ask you, are you seeing business opportunities being presented to you that are based on like the emergence of new data sets that were, let's say, not available 10 years ago?
Yeah, obviously this is a rapidly moving market. I mean, I'm a kind of generalist, so I'm not a weather specialist. So that's kind of a hard question for me to answer. I'm more interested if people come to me with specific ideas, then what I do is test them out. Is there a business plan? How large is the addressable market, and so on. Can you make a return from this investment? That's kind of where I come from. I'm not a specialist technologist.
Yeah, great. So Josh, you touched on the fact that this climate projection, climate risk space is sort of rapidly evolving, and it's related to changing weather conditions and changing climate, but also sort of industry and governments coming to the realization that there is a growing problem. One of my experiences in the weather industry is that one of the ways to gain success is by identifying an emerging opportunity and doing everything you can to be the dominant provider in what starts off as a small emerging opportunity. But as it grows over time, if you're dominant in that space, you grow with that developing opportunity. Is that what you see happening today in climate sciences for risk mitigation?
That's exactly what's happening today. To tie it back to the sort of the insurance question a little bit, one of the key challenges, for example, is that the insurance, at least in the part I see, insurance is very complex. There's a lot of insurance conversations you can have, but the traditional underwriting problem is based on existing catastrophe modeling capabilities, which are not well suited for climate change at all. In fact, there's strong arguments that they're already out of date. But how to fit the climate information into their work streams is an entire challenge all in and of itself. So the insurance companies are trying to figure out how to do this while we're talking to them and trying to figure out how to supply them the information they need, et cetera, et cetera. And so those are the kinds of conversations we're having. It's exactly right. I mean, we're positioned very well in the current state of the market, right? And our job is to make sure we stay there as the market opens up.
Yeah, I can imagine that in the discussions you're having, the requirements are sort of changing on the fly as new things happen.
They absolutely are. And, you pointed to there's a rapidly rising regulatory environment that was all voluntary very recently, and it's starting to become law and probably will continue to become law. And so how that sorts out in financial institutions, for example, is still to be determined. But it's happening very quickly.
Great. Rebecca, a question specifically for you. Do you use publicly available weather data to calculate risk, or are you using private sources of improved data?
Yeah, so we're using, we are still using public data sources, which is exactly who all the insurance, most of the reinsurance agents are using as well. We do know that there's a lot of basis risk with it, depending on the location. And there's also, again, as Carlos said, the data in the United States is fantastic, but you go to some of these other islands and places that don't have that kind of level of data, and we have much more trouble trying to really write those policies because they don't have the good data. So there are some companies that we use that are privately owned, but I think there's definitely a big market there for new companies to come in and take over what some of the holes that the private or that the public companies still are dealing with.
Right. Alan, you mentioned being an investor in some innovative companies, and you listed off a set of categories that make an attractive business. One of the questions we're being asked is, how important is quote unquote being innovative in terms of securing an investment in a startup or in a post-startup business?
Innovation. That's the key to everything, isn't it?
It is, isn't it?
I mean, look, where we've found useful, we backed eight to 10 companies from Denmark, for instance, which is a world leader in wind energy. So we've backed companies coming out of the Danish Technical University, and what we find with universities is that very often the companies that spin out of them, got very good families of patents backing them and so on. They've been not resourced with capital, but resourced with skills from the departments. And very often they've teamed up with good entrepreneurs before we see them. So yeah, innovation is key to everything, and we're finding that in spin outs from universities.
You have, in your evaluation, do you have a formal way of evaluating innovation, or does it tend to just come through the business plans and developing some understanding of the unique offering that a company is proposing to fund?
I think a lot of companies now are using this NASA concept of technology readiness level. So we'd expect them, to be up at,
right,
level 5 or 6 probably.
Right.
Put significant money in there.
There was a question asked that I saw Josh was starting to answer via typing, but since we have a couple of experts on the line, I'll ask it as well. What is the role of artificial intelligence in the weather and climate space, and how's it changing it? Carlos, why don't you take it? Why don't you start? And how do you see, what are the unique applications of machine learning and artificial intelligence occurring within the field?
Oh,
and in particular, being applied to businesses?
Thank you. Great question. So from my perspective as elected member of the Artificial Intelligence Committee of the American Meteorological Society, we see hundreds of submissions every year on weather and climate domains relating AI and environmental sciences. Over the last 10 years that I have been in the committee, we had seen the conference grow from 20 persons to 400 attendees per session, going multiple sessions. So the role in many ways it's fantastic, because they replace linear methods. Second, they can be used in climate, even for dynamical modeling, to replace parameterizations. Third, they can use to do downscaling, as Josh was mentioning, that happens at the climate scale. We're using IPCC models, like that's probably what I did for my PhD thesis. And in the weather aspect, you can do model output statistics You can also use them to cluster data, aggregate data more effectively without a human in the loop, or with supervised and supervised learning. We use it for impacts in human health. For example, we did a machine learning based forecast for Vibrio and cholera outbreaks in the Chesapeake Bay here in the United States. We use it in collaboration with NASA, as Jan was mentioning at the beginning, to do forest fire forecasting and drought indices. So applications are almost as far as your imagination can lead you to, because at the end it's a tool. You have to know the limitations of your tool and use it the best way possible. And that's probably what Josh uses in his organization as a chief scientist. He has to understand it and tell everybody to use it responsibly. And that's probably one of the biggest limitations of AI now, that sometimes the practitioners do not know, okay, I will use this model that is freely available online, but then suddenly you're going to do climate change assessments. Suddenly your projections have like 500 degrees Celsius. And sometimes if you don't come from climate sciences, that number could fly, so you need quite QC, you need to understand the physics beyond it, salinity profiles, precipitation, it's binary, but then you also have like magnitudes that sometimes you get numbers that I have not been seen in the historical record. So at one point it's climate change and at what point is not. The same thing with weather. Like at what time is an extreme event? Is this precipitation coming from a hurricane that could actually bring this amount of water? Or is that the machine learning model broke and it was not designed to deal with this kind of event? So
Yeah.
Josh, all yours.
I have nothing to add. I was going to add the issue of explainability. It's huge, especially in the financial sector. And I mean, there's two aspects to that. One is we have physics, right? So there's entire fields of physics guided data science. And so the methods sort of unconstrained problems that pure data scientists are used to working in. The methods might apply, but you can't really necessarily apply them in the same way. And then secondarily, not really secondarily, in addition, you also have to be able to explain the results, and physics can help there too, but not always.
Rebecca, in this discussion around artificial intelligence, I'm thinking about that there's an emergence of parametric insurance products in which contracts are written off of, say, a single index. And that index hopefully is designed to as much as to maximally identify or measure the risk of a factor that is weather related. And those indices tend to be, let's just say that they're linear, relatively simple in construct. Do you see a possibility for using, say, machine learning to create an index based on nonlinear relationships that you could then write or transfer a risk on? Which is to say, do you think could indices become more complex, and would the market take on that risk as long as the methodology for creating the index is transparent?
Yeah, absolutely. I think that we're going to see in the next, let's just even call it 5 years, a lot of these products being run by, some sort of AI. And I think that as a problem that we have right now, it's really, we're basing things on what's happened in the past. So the more data that we can collect and we can input into these machines, they can run this sort of model for us. And once we have those numbers, then we can just attach them to some sort of, weather product that would work for people. So I absolutely believe that we're going to see a huge influx of AI just with the data alone. That will help all of our products relative to insurance.
Great, and that was a complex question, and I'm going to go now to a more simple question around weather data and the insurance industry. And the question is, how does the insurance industry actually use weather data? Like what parts of the industry are using weather data, and what kind of decisions are being made from it?
Sure. So we're using weather data for any index that affects people's financial, bottom line. So wind, obviously, in hurricanes, temperature, rainfall, snowfall, humidity. We have some crops that are really affected by humidity. Anything that we can measure relative to that index and we have some historical data on, we can write a product for. Now, as I said to you, something like lightning, you know, lightning is such an intermittent thing, and it was so difficult for people to get lightning data. They didn't start doing it till I think 20 years ago. And so if you look back on how to price something like that, we can't price a derivative against no data. So having that data, the longer the data we can get back to, so 70 years, we can go back to temperature data, the better the price is. So the benefit for the client is the cost is going to come down with more data.
Do you envision that there'll be a market at some point in which parametric weather risk contracts are traded publicly or on some open market?
Yeah, I think that's absolutely already starting to happen. You can go on yourself, Jan, on some of these platforms, and you can type in what you want. You know, you go on vacation and you decide you want to buy a weather derivative for the week that you're in Costa Rica. You can actually do that. You know, those are things that are all happening now. I know there's even some companies that are working with cryptocurrency and using, you know, that market. So I think we're seeing a lot of this really get down to the basic user.
Great, great. And so the webinar is focused on some of the particular challenges of, let's say, leaving one sector of what is the global weather enterprise and starting in the private sector. And I guess, Carlos, you had mentioned competing, you have to compete and be better than free. And I just wonder, like, what advice do you have to folks to make sure that if they want to start a business, like, how do they evaluate whether the product is better than free or not?
Thank you, Jan. Great question. And at the end, it comes from understanding the users, like identifying who, or like basically which problems the sector has or the users have. And many data is free, but doesn't mean that the users are using it effectively. Or maybe they need to invest, it's free, but they need to hire a software engineer to ingest the data. And not everybody has the resources to invest, you know, $500,000 in all those pipelines just to get actionable information. So maybe creating a API from point A to point B solves that problem. Maybe just a visualization tool, a dashboard that brings all those spreadsheets into an actionable figure that they can act on it. Like as just one mentioning, maybe risks, synthesizing the information in categories that are more digestible. So what does, you know, 40 Celsius mean to you? In many ways, it depends on where are you located. So 40 Celsius, if you are in the mountains in Colorado in winter, it's big. But if you are in Hawaii during summer, maybe it's not. So it's also trying to contextualize the information. So there is lots of information. It's, as you said, like probably terabytes, petabytes of free data. But people are drowning in all that data and need, in many ways, integrators, facilitators, and companies that will help them. And some of the data, even for our international audience, it's in English.
Yeah.
A great service is just to translate it. It's like it's the reality. It's sometimes it's a real barrier of accessibility of free data in economies outside of English-speaking countries.
Yeah.
So your solution could be as complex as deep learning neural networks for you know, extreme events, or it can go like, I am going to make a platform where the people of my country can actually use publicly data. So those are just basically identify the need, identify where the gaps are in the market, try to find a solution, and if you can monetize it on that, fantastic.
Great. Josh, I'm curious in your business, because you're focused more on, again, on climate projections and physical risk. You know, in the weather industry, in my experience in the weather industry, when you're competing on better than free, you end up answering very specific questions to solve very specific business needs, because free services they're trying to serve all people for everything, and that tends to not work when you get very specific. Is there an equivalent of better than free in this emerging climate risk identification segment?
I mean, I think there is at a baseline, but the bar is much, much lower. There's far less, at least in the United States. Maybe to some extent it's different in Europe and other countries, but I think generally speaking, relative to free weather, it's not even close in the climate sector.
Yeah.
You know, the vast majority of it is just produced by labs and universities and really not packaged in any way that's useful. Right. There's no such thing as a warning or MOS or, you know, model output statistics or anything like that. So.
Right. And then Rebecca, for you in your business, you don't compete against free because there's no free risk transfer, almost by definition.
Yes, you are correct. There's no free here. You're absolutely right.
Do you think that makes, does that make what you're doing a potentially more attractive business opportunity, or does it come with its own set of risks that makes it, you know, it's not easy, it's not difficult, it just is?
No, I think it definitely has its own challenges. You know, I think for us, the biggest challenge is just educating people that these products even exist. So even trying to make them very simple, a lot of people just can't get their head around the fact that there's a weather insurance like there's a car insurance, right? So just really educating people for us is one of our biggest challenges. But obviously, yeah, they have to pay for it like any other insurance. And if something happens every other year, it's going to be expensive if you can even find somebody to cover you.
Right. Great. I'm going to change direction a little bit. Alan, I have a question for you. So you mentioned that I think you've invested in 31 companies overall, which means you probably reviewed, I can't even imagine how many you review every month, every proposals that you review every month. In your reviewing of the potential companies to invest in, what is the number one mistake that companies make in their pitch deck in trying to convince you and your company to invest in them?
Okay. Pitch decks, yeah. I think not explaining yourself properly, not explaining, you know, what your revenue model is, where you expect to make money. I would say that's the biggest thing. I mean, it's not hard to do a good pitch deck these days. I mean, you can find examples on the web. There's a website called pitch.com. You can look at all the early pitches from, you know, all the famous Wall Street names now. So yeah, you just find the resource and put some effort into putting a good deck together. And you know, 20 slides is enough normally. I often find issues if you know, there are these pitch events where, you know, maybe 20, 30 companies are pitching to, you know, an audience of investors and so on. And you basically got two or 3 minutes to explain your company. I mean, the biggest mistake there is if you can't explain what you do in 2 to 3 minutes, then you should probably give up.
Yeah. And do you think that in the idea of not being able to explain or not explaining properly, do you think it's because founders don't understand their own business plan well enough, or just they're unable to communicate it properly?
I mean, it may be nerves at an event, I suppose. It could be just nerves. They could be the brightest, you know, person on the planet, but you know, if you're nervous and can't get it over, then obviously that's a problem. But yeah, you've got to spend, you know, as I said, 50% of the time, some CEOs or COOs are, you know, spent preparing, you know, for capital rounds. So you know, you've got to put effort in to attract the right money, I think.
Right. And then Alan, once you fund a company, what is the biggest challenge that company faces to say get to the next level in terms of revenue generation or growth?
I mean,
what's the biggest challenge they face once they've reached the holy grail of an investment?
I mean, over 90% of companies that I've seen don't make their projections, which means either their costs are too high, or their costs are high, or they're not getting the revenue that they thought they'd get, which means they need to raise more capital than they thought. You know, VCs are used to that. When the perfect company comes along and beats its forecast, then
yeah,
that's a very valuable company.
yeah,
But so underestimating how much is needed, particularly to penetrate new markets. Sales and marketing is expensive. If you're setting up on a new country or new continent, don't underestimate how difficult that is. Products don't sell themselves. You often hear people, this is my product's so good it's going to sell itself.
right.
Never seen one yet.
I have yet to experience that type of product. I wish I could.
Mm.
So we're here talking about starting up weather or climate businesses, and a lot of what we do is forecasting. And so in weather forecasting or climate forecasting, or even climate data, there's a concept of bias, which is that the model is fundamentally or systematically different than the observations. What you just described, Alan, is that the financial forecasts tend to be systematically different than what actually happens. So I'm curious, in your evaluation of the business models and your willingness to make an investment, do you factor in the fact that 90% of the financial plans end up being missed? Like, do you factor that risk in?
Well, we're kind of, to some extent, we're an intermediary between investors and companies.
Right.
So we're not kind of a pure VC. So we're kind of on the side of the companies, helping them explain things to the investors. So with projections, obviously, I always like to give enough detail on the income statement and the balance sheet and the valuation methodology. If you show your workings, then the end investor can, they can haircut the revenue numbers, they can add something to the costs, they can cut the multiple in half on exit. And if that still gives a reasonable risk-adjusted return, then that's okay. And then, the issue about, are we raising enough money now to get to the next event? I mean, a lot of companies come along and say, we need 2 million to get us through to cash generation, and then we'll be self-sustaining. That hardly ever happens. So yeah, prepare for the next.
I had a conversation just recently where someone, maybe it was you, Carlos, someone said the problem with seeking a venture investment is, as soon as you get that investment, you're not focused on the customer, you're focused on winning your next investment, which is to say growing your business to the point that you can secure your next investment, and that it takes a series of investments to really reach scale in many times. Have you seen that in the industry? Alan, I'm asking you.
Sorry. Well, look at Spire. I mean, Spire's been through, I think, six rounds or so before it got to a position where somebody thinks it's worth listing on the stock exchange. But that's the way of the world, isn't it? I mean, obviously, we like companies to get to, often we invest pre-revenue. It's nice when they get revenue, and it's nice when they become profitable. But for instance, the exit we talked about, Humio exited for 400 million to CrowdStrike. I think they exited on something like 20 times annual recurring revenues, which is a lot higher multiple than we thought when we first invested in them. But they were a little bit behind on revenues. but they were nowhere near profitability. But somebody was prepared to pay 400 million for them because they were in a space that was attractive to the buyer. So to make a great return, you don't have to get to profitability. But of course, if you're not profitable, the danger is you can run out of money, and then all your hard work's wasted.
Right. And then, Alan, there's a question that comes from the audience, which is, how do I get my business in front of investors?
Well, that's so easy these days, isn't it? But look, I think you've got. It depends at what stage you are. Whether if you are seeking your first money, then obviously the usual thing is get as much soft capital as you can. You were talking about better than free. There's no such thing as a free lunch in investment, but you can get free money, which is from grant making bodies like EU Horizon 2020 or Innovate UK in the UK. I don't know what they are in the States, but there's plenty of government money or quasi government money washing around, and that is free because you don't normally it's a grant, you don't have to pay it back, and it doesn't take any of your equity. So you use as much of that as you can, and then friends and family, and then start preparing for a seed round or a Series A round, and so that means get some help from incubators and people like that.
Yeah. Yeah. So I'll add in, right. There's a natural progression in my view of a startup. One is just the conception of the idea and trying to just see if the product can be created in the minimalist version. There is trying to see if there's actually a market for what you do. And, that's the stage where you're working in, the classic garage company type thing. And then if you can prove the model, then you move into, say, seed stage. And I know in the United States, there's things like small business innovation research grants. There's lots of, there's different grants around that they're not particularly supportive, particularly designed to support the weather and climate industry, but they will because they're environmentally focused or climate change focused. And then if you can demonstrate success, you can head towards some venture-backed businesses. Alan, you raised a good point and maybe Josh, you've experienced this early on, but certainly again, in this realm of trying to facilitate climate adaptation and climate mitigation from the academic, the government, and the private sector standpoint, there is a lot of support out there for innovative new ideas that help solve climate-related problems. And so I don't know, again, the person that asked the question, I don't know if it's weather or climate or where you are, but in general, I can say doing a little bit of work in terms of just trying to identify small business support in whether it be the United States or Europe or Asia or Africa. There are organizations out there that are supporting efforts as long as your mission is aligned with their mission. And you can at least test the idea. And at some point it becomes up to you as the business manager to make the business successful.
Yeah, I'll add, that's exactly right. But I'll add that there are also a growing number of startup accelerators that are aimed at the green sector, broadly speaking, and climate change kind of fits pretty squarely into that. So those are opportunities as well to get money. Usually you have to give up a little bit of equity to do it, but then they supply a cash infusion to accelerate your development. So there's like I said, like Alan and you both said, and that there's just a lot of opportunities out there to find support in early stages.
Yeah. So I guess I want to make sure. So I guess, Josh, you come from a science background. Carlos, you're a science background. Rebecca, if I remember properly, you come from a finance background. And so I guess Josh and Carlos, you were in the academic or government sector, and you went into the private sector. Rebecca, you were in finance, and you're still in finance, but you've stepped into this realm of a fairly technical field of weather and climate related information. And so I'd like to ask the three of you, when you decided to make that leap from say government or academic into private sector, or Rebecca, finance into this weather risk space, what was the most surprising learning for you in getting involved in this side of the business? Josh, why don't you
I guess I
start?
can start really quick. I mean, to me, and it sort of seems normal now that I've been doing it for 4 years, but the pace of development and innovation is blistering, okay, compared to what me and my teams were able to do before. So
Yeah.
I think that's the biggest thing, and maybe it shouldn't have been a surprise, but that's just the facts.
Yeah. Rebecca, what about you?
Yeah, I think things are changing really quickly in this space, and that wasn't the case so much with just pure finance. So I feel like it's not just the weather that's changing all the time, but even as we spoke earlier about climate change really being an issue for us in how we're pricing now. You just, every day, every week, every month, we see new things happening that just sometimes is a huge surprise to us.
Yeah. Carlos, what was most surprising about the transition for you?
For me, the most surprising part was to get used to some of the definitions used in the startup world and business world. That is like, they say, okay, we are going to build an MVP. And coming from academia and following sports, I say like, oh, wow, great, MVP, Michael Jordan, you know, Cristiano Ronaldo, whatever. So it has to be the best product available. But in reality, then I struggle like the first week is like, but this doesn't look that we are trying to build the best product available. No. And then I have to ask, what is MVP? It's like, oh, no, Carlos, you were confused. It's minimum viable product. It's the minimum unit that you can go and sell. Don't over-engineer it. It's not your most valuable. It's not.
Yeah.
Don't try to make the solution that always works for everybody and is perfect, because then you will never sell it. That's the concept, MVP. And that's something that we never hear in academia.
Yeah. So I will say, I'll follow on Josh's comment that one of my learnings pretty early on was you can't let perfect be the hindrance of progress, right? Which is to say, if you wait for the perfect solution, which is the same thing as Carlos was saying, the minimum viable product is most definitely not perfect, but it as I said right at the start, it gets your product into the marketplace, you start getting feedback, and you get to experience whether or not it's going to be viable or not. And then you work towards making it the maximally viable product. But to do that, you can't wait for perfect, or you will never succeed. So that was my primary learning. We have touched on a little bit the difference between, say, the weather services market and the climate services market. Josh, I had mentioned that there's this emerging opportunity of climate services for risk identification and climate risk identification. And I'm just curious the degree to which the panelists think that the investment industry itself is going to be a big consumer of climate data and climate services. Certainly there is, with the emergence of the TFCD, the Task Force on Climate Disclosures. There's movements of some of the world's largest investors are asking their holdings to disclose their risks. It would certainly seem like it, but I'm curious what's the early look and what's the long-term view of the potential for the investment industry to be a consumer of climate services.
Sorry, I was typing my answer. It's possibly still speculative, but I think there's a growing interest in that from investment firms. Some are extremely diverse and they're global, and you know they want to know where their money is and where to take it out of and where to put it. So it's there's sort of a clear use case there. I don't have a view on sort of the speed or the breadth of the uptake, however.
I'm curious, Rebecca, you have a particular capability of analyzing the risks of end users. Are you finding the investment community engaging with Weather Risk Global to understand where their risks may be in their portfolios?
Yeah, we are working with a couple companies, without naming any names, that have really put a lot of efforts in and money behind really deciding or really evaluating who is investing where and relative to weather, what those risks are. So we're definitely seeing that. I think we also do a lot of work with ESG and another opportunity there. I mean, Larry Fink wrote that letter for BlackRock a couple of years ago, and it just sent everybody into this tailspin of all of a sudden we have to know what's going on. So we're finding that we had a lot of questions and even are helping people just with what their risks are. They don't know what happened, in their community 20 years ago if they didn't live there. So those are things that we definitely work with people a lot on.
Carlos, I wonder if you have a view. Do you have any experience in the investment community and its use of climate services?
Yeah, so from my perspective, you could see the information in the market that will probably lead to positive changes in the space, or at the end, changes in the way that they will end up consuming climate information. For example, Bloomberg's letter of last year saying that they need to analyze the impact of the portfolio and the climate impact on specific assets. Those are signs there. Sometimes you see the customer or consumer-driven solutions, for example, like when in the 90s or the 2000s, when companies started to, or the world got worried about labor practices. The companies have to disclose labor practices. So the companies had to disclose if they use clean energy, how much they contaminate, and so on. So now there is also, and actually you can build a portfolio if you have accounts in investment funds. You can say, I want to have like a portfolio that only gets companies that are invested in clean tech, or that the labor practices are aligned with my views. Now there's like all these niche segments that will lead to those kind of solutions. And the same thing is going to happen with climate change inevitably. There's one, because of exposure, or you don't want to be exposed. And second, because depending on your views, people care about climate change to a certain degree that could affect how they build their investment decisions. So yeah, you could see the trends in the market going to that direction.
Right. Alan, not too long ago, Moody's took a big stake in 427, a company that provides climate risk services for investors. I'm wondering, again, in your review of the industry, are you seeing a trend developing of additional companies in this particularly financial climate risk services market starting and providing new capabilities?
Yeah, I think MSCI bought, was it Carbon Delta? I think it was same year. And we backed a company called Datamaran, which is a few years old, but they originally started just on non-financial risks for companies, ESG. But obviously climate change has really zoomed to the top of the charts in terms of what investors are looking at. So they're moving into that space as well. And yeah, I mean, there are even now companies developing apps for individual investors, for consumer apps, to actually tell them what their stock portfolio or their fund portfolio, what the climate risks are. I've not actually seen one pitched to us yet, but I mean, it's definitely out there. Yeah, so, as you said, it's moving at pace, this industry.
Great. So incredibly, we have reached, we're very near the end of the 90 minutes that we've all allocated to attend the webinar. I will say thank you to the panelists for your insight and wisdom, and to the audience that is attending. I can say, if you're thinking about starting a business, I'll take my message and say, make sure you understand what your potential customers want and how they want to receive it. We talked some about making sure that the data is available and that you know how you're going to value add it. And as Carlos identified, the product doesn't have to be perfect to get started. It just has to help provide some value. And I think most importantly is just that there is a wide range of opportunities, and we covered a lot of ground in the potential segments today. And so I can only say good luck if you make the leap. We have a set of panelists here that have all successfully made the leap, and undoubtedly you can make the leap too. So that concludes the webinar, and thank you very much everyone for attending. And a recording of the webinar will be available in the next few days. You will all get an email if you registered for the event when the webinar is available. We'll also be announcing the subject of our next InterMET.digital webinar, which will take place next month. And finally, if you have any questions you'd like to ask the panelists after the event, you can email ian@mediageneration.co.uk, and that information will be here on the screen. And finally, if you have any ideas which you'd like InterMET.digital to explore around business themes regarding weather or climate, please let Ian know, and he will look into organizing one. Thanks, everyone. See you on the next one.